Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and in the world of wealth management, and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. Thank you for taking the time out of your busy schedule to join us. We are recording this so that those of you who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson. We will have a question and answer period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we invite you to feel free to ask questions. Well, tomorrow is Canada Day, so I want to wish everybody and the country a happy 148th birthday. So HighRock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April to help build our private client business, and we're off to a great start. We have added a number of new families over the past couple of months, and we're actually talking to many more, and they are all thrilled with the direction that we are taking. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. Now, we're not brokers, we're not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Most financial or investment advisors are not paid to manage money. They are paid to gather assets and find a mutual fund or other third-party manager to place your money with. In fact, many advisors place their clients with money with HighRock. This means that those clients are paying fees on top of fees. In essence, our private client group is intended to try to take out the middleman and save our clients money. Now, importantly, all of us at HighRock have our money invested in the same models as all of our clients. So whatever we do for all of us. Our interests are aligned with you, our clients. Our fees are simple and transparent, and we take our responsibility to you, our clients, beyond what is required by the regulators. So let's move to the risk analysis section of our weekly calls. Here, we're always seeking the most efficient way to maximize return while at the same time minimizing risk. Our goals for your portfolio strategy are to get the best possible returns and take the least amount of risk, and to do this within the scope of your goals and your tolerance for risk. Using our measure of risk, the annualized standard deviation, which runs along the horizontal axis, risk increases as we move from left to right. A pure equity portfolio like the S&P 500 or the S&P TSX indices can attain potentially higher returns. However, there is higher levels of risk needed to get there. In comparison, our research shows us that a globally diversified and balanced 60% equity and 40% fixed income model can significantly reduce risk and still achieve an annualized return of between 7 and 8% over a multiple year period. This level of return for that risk taken is what we consider to be optimal. At HighRock, we have three models with which to create balance and diversification. A fixed income model with bonds and preferred shares with varying risk characteristics. We have a global equity portfolio model that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations. As well, we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research for better than average growth. For our clients, we use these models to create portfolio strategies in keeping with your desired goals. Last week, Paul covered our research process in detail. We develop ideas and follow an in-depth process to determine their suitability and value. Only when they meet all of our stringent criteria do we actually execute our buy orders.
Hey, Scott?
Yes.
Can you just go back to that slide for 1 second?
Absolutely.
So I think we spoke on this last week, but I would just highlight on this slide that, and I think I said it last week, but I would hazard a guess that there's not a single investment advisor in the country that does the fundamental research that we do on idiosyncratic risk, whether it's credit risk and investment grade or high yield, or individual stock risk. And I would also hazard a guess that the research we do goes likely deeper than most mutual fund portfolio managers that I know. So we do have a process behind, and that's not to say we're not going to have some picks that don't work out perfectly, but we certainly have a process in place that tries to eliminate less profitable investments and maximize the profit.
Absolutely. And thanks for chiming in, Paul. That's great. Okay, so let's move on to bringing in our themes for 2015 in the context of our risk analysis, and let's assess the risk of some of the latest developments. One of our key themes and the underlying theme, I guess, for 2015 is to expect the unexpected, and certainly this week we have been barraged, I will say, with some developments that have obviously brought market risk into context. And as all will be aware, the developing Greek situation with no deal on a bailout, with a default on a payment to the IMF this evening, in fact, 6 o'clock North American time, and a referendum or potential referendum on Sunday has certainly led to increased volatility and higher levels of market risk. Developments continue to evolve, so there's lots of knee-jerk market reaction to rumors and other media insight. All of this uncertainty is forcing investors to move from riskier assets to safer assets. And when the selling of riskier assets drives prices down, and it also increases levels of volatility. And that's what we've been seeing certainly the last couple of days. Volatility has increased significantly from where it was. However, we do have to keep current levels of volatility in perspective. And if we look back over the years, we can see where there has been other escalations of volatility, and at the moment, nothing in comparison to some of those. So we do know that volatility may escalate, but it will depend on the outcome of the referendum and other developments according to how it's perceived by markets that this Greece situation will play itself out. Well, we also have another theme, and we know that central bankers do not like volatility because it undermines confidence. So we know that they're going to be closely monitoring the developments with Greece and will assess whether it will ultimately produce any unwanted economic developments. And of course, they'll act accordingly. And certainly, there are contingencies in place should volatility get more pronounced. Well, another risk that we need to monitor, and we discussed this, I think, a little bit last week, is foreign currency risk. And there is foreign currency risk inherent in our portfolio models. So we're monitoring it. And interestingly enough, last week on BNN, Paul was interviewed and asked about his expectations for the euro. If a Greek default or exit from the euro would become a greater risk. And his response was that he believed the euro would benefit from a Greek exit. To take that, the uncertainty that Greece brings out of the equation probably would benefit the euro. And indeed, despite opening lower yesterday, the euro bounced to its highest level in a week. And we continue to monitor how that will evolve. But Paul, did you have something to add?
Yeah, I'm part of that story about a stronger euro, and part of the story of the stronger euro really is that you take out the weakest link, being Greece, and the euro will naturally gravitate higher. And I think the risk for Europe and those that remain in the euro, those being the stronger nations like Germany and nations in the north and perhaps even France, is that a stronger euro is going to restrict exports, and that will hamper economic growth, which hampers cash flow, which hampers stocks. So that's part of the reason why we're a bit more negative on certainly European stocks. We also think that's going to affect emerging markets.
And based on that, in all likelihood, because this is not something that the stronger European nations want to see, there may be some impetus on their part to try to find some way to keep Greece from exiting the euro. Okay, well, a flight to quality, as we've seen, where riskier assets are sold and safer assets are bought, also impacts bond markets and also interest rate risk. And what we saw yesterday was riskier Italian bonds, for example, were sold off, and that drove prices down and bond yields higher. At the same time, we had safer German bonds are being bought as people moved out of the riskier assets into safer assets, and that drove prices higher and yields lower. So we have to keep an eye on the interest rate risk, of course, as it evolves as well. As far as economic growth, one of the themes that we've been continually discussing is that we expect the U.S. Economy to show, or actually not we, but it is expected that the U.S. economy will show stronger in the second half of 2015. And although we won't get readings on U.S. data for this third quarter until August, we're still monitoring second quarter data, and let's just talk about a few of the most recent releases here. Today we saw the latest readings from the Chicago Institute for Supply Management, which showed continued subdued activity. In fact, levels below 50 in this index are where they have been for the last 2 months are considered indications of a contracting economy. So certainly we're monitoring that situation. Consumer confidence came out today. Consumer confidence continues to rise, but unlike last year when the retail sales numbers rebounded after a tough winter, there has not been a similar rebound yet, despite cheaper gas prices. So one of our additional themes, and we've talked about this a little bit for 2015, is that we're experiencing a changing demographic in the consumer sector. Baby boomers are saving for retirement and spending less. And now the largest cohort, the millennials, are coming along, but they've got different priorities and consumption habits. And interestingly enough, I covered a recent study by Goldman Sachs in my blog last Friday, and their conclusions were similar to ours. And among a number of things, basically that millennials just don't have the same amount of money to spend. And that also will have some impact on consumer behavior. So again, it's something that we're monitoring, but it's an interesting development. This week, key economic data to come. It's the U.S. Employment Situation Report, expected to show the hiring of 230,000 non-farm payroll workers, which is lower than the number from last month, and then reduced lower average hourly earnings as well. So we'll have a look at that on Thursday, and then of course Friday is a U.S. holiday. In Canada today, we saw April GDP data, and that showed continued weakening in the economy based on weaker industrial output. Bank of Canada Governor Stephen Pawlis is anticipating that the U.S. economy will lead Canada's economy to better growth in the second half of 2015, but of course, we're waiting to see how that all unfolds. On the inflation-deflation front, last week we saw a key U.S. data, the U.S. Core Personal Consumption Expenditure Index for May, which showed a decline, and the current level of 1.2% is certainly well below the Fed target of 2%, which means that in this, given the circumstances, if volatility does remain with us for an extended period, the Fed does have some room to breathe with regards to when they may start to raise interest rates. So the expectations are that they will do so in September, but that could be postponed depending on developments, and certainly on economic developments as well. And finally, we continue to talk about how equity markets are expensive. They are starting to get cheaper as participants move away from risk, but certainly there's still some way to go. And again, back to market risk. But let's look at the S&P 500, which is down 3% from its all-time highs in April. We do think there is potential for it to drop further if we don't see buying support materialize. A correction of 8% would not be out of the question. That would take us down to a level of 1970. But if buying support is not enough, there's also another level below that. Last October's lows around 1830, 1840. That would be the next support, and that would represent a correction of 13%. So again, we think that as we've talked about fundamentally, that stocks are expensive. We're about to enter second quarter earnings season, and the expectations are for a decline in earnings of somewhere around 4.5%. So that means that stocks remain expensive, certainly in our estimation, and unless we see a more significant correction, that will continue to be the case. So we're comfortable waiting for that correction still, and we know that will happen when it happens, and we'll continue to remain patient. So let's now look at our portfolio models that I mentioned earlier and talk about how we're viewing them in the context of the current environment. So first, our fixed income models. And certainly there's been plenty of volatility in fixed income markets recently. Bond investors have been selling significantly since April, driving a trend to higher yields. We've been waiting for opportunities to make purchases, but recent events surrounding Greece have temporarily reversed this trend, so we have to continually monitor this. But we have predetermined buy points at yields that are higher than the current market yields, but if we need to make adjustments, we will, and that is part of our ongoing process. So we've got our U.S. buy points. We also have our Canadian buy points. And so moving on to our global equity model, continuing to look for opportunities. The impact of recent volatility with the added Greek uncertainty, we've been adjusting some of our buying points. One of the larger components of the non-North American large companies ETF that we use are companies that are domiciled in Japan. That makes up about 23% of this ETF. Now, Japanese equity prices have been trending higher since last October, but with Greek-induced volatility, are testing buying support levels. Now, something that we brought up a couple of calls ago is that the Bank of Japan can actually buy equities as part of their stimulus measures. So they've been supporting the Japanese equity market, and that's something that we always have to consider, because that could actually mean that Japanese equities are significantly overvalued, and we want to monitor that as that situation evolves. Another of the large components of the non-North American large company ETF that we use is our companies domiciled in the UK. That makes up about another 19% of that ETF. We've been watching prices in the UK. They're down about 7.5% from their highs, so generally correcting, and have definitely broken the uptrend from last December. So we're watching the new downtrend as it is evolving, and obviously looking for the right place where we might begin to step in. Also in Germany, prices are down around 11% from their highs. Another interesting topic I'd like to bring up on the global equity portfolio is that we're always trying to add value. And back in April, after a period of fairly in-depth research, we decided to switch our non-North American ETF to one that we believed was not only had a cheaper management fee, but also offered some potentially better risk-adjusted returns. So the one we switched out of, the ETF we sold, has actually had a negative total return of about 2.3% since we made that trade in May. In comparison, the ETF that we purchased has actually only had a negative return of 0.35%. So a benefit of close to almost 2% for our clients. So our work behind the scenes is actually paid off. And sometimes it's about not just about getting growth, but also about finding better ways to protect our clients with solid defensive strategies. And so these are some of the things that Paul and I work on, as I said, behind the scenes, always trying to assess where client money might be better placed in order to benefit them. Also, let's just take a peek at what's going on in China and the emerging markets. After hitting highs in earlier this month, and actually on June 12th, Chinese prices have dropped by 17% in just 3 weeks. But they were actually down over 25% at the lows before bouncing higher today. I think last week we showed that they were down about 11.5%. So serious volatility here. The Central Bank of China came in, dropped borrowing rates over the weekend by 0.25% to try and stem some of the volatility. But as you can see, things very volatile in China. And it's translated over to emerging markets as well. And this is an area that we've remained actually underweight of our target allotment for our model. So again, being cautious and in fact, even lowering our buying price for the remainder of what we need to buy because the volatility has increased so much. As far as our Canadian growth equity model, Paul, did you have anything that you wanted to throw into the conversation?
The story is still much the same, and I think all those equity charts around the globe reflect our views in plain sight. The one chart that I certainly look at more for smaller mid-cap valuation metrics is that enterprise value to EBITDA chart that we've seen the last few weeks, and it's trading up at, just to give you relative value, at 12.25 times, 12.25 times. And a lot of the companies we look at, and certainly one we've invested in over the past 2 weeks, a chemical manufacturing company that we've done a lot of work on, and we know one of its competitors really well. We had a discussion with them last week, and we feel like there's potential M&A opportunity in this particular target, this chemical manufacturing company. But to give you an idea, we own this company pretty much at the lows. It's been hit down so hard. We think it's de-risked enormously. Just to give you an idea, the market, the S&P is trading at 12.25 times enterprise value to EBITDA. If this company we own was taken out at 8.4 times, we would have about a 30% return on our investment on that stock in a reasonably short period of time. And again, that's at 8.4 times. That's pretty cheap given where the market is. The overall market is trading at 12.25 times. So I think the overall markets are very, very rich. So we remain patient. We're going to wait and pick our spots. We do our work on the names. We look at technical charts, as you've seen through the presentation, and we will remain disciplined on our buy points because we can afford to be.
Thank you for that. That's great. So just a housekeeping issue. We've brought this up last week, but we've continued to update our website. And thanks to our summer intern from the Honors Business Administration program at Wilfrid Laurier, Mitch has been doing a great job for us. So please don't hesitate. Go check out our website. Lots of things going on there. And especially don't forget to check in to the High Rock Challenge survey if you've not already done so. Also feel free to send it to your friends and family. There's a serious prize involved, so we want you to get to it. And in fact, we'll be drawing the prize from all of those survey participants on next week's call. So don't forget to tune in for that. And this is the time of the weekly call where we go to any of our listeners who might have a question. So if anybody out there has a question, please feel free to ask. I think, Paul, most folks have already left for their Canada Day weekend, so I don't think we're going to get a whole lot of questions here. But if anybody is listening to this or listening to the recorded version, want to ask a question, please send us an email, give us a call. We're always happy to engage. But that's it for another week, and thank you all for taking the time to tune in. Have a wonderful Canada Day, and for our U.S. listeners, happy Independence Day. And everybody have a great week, and we look forward to being with you again next Tuesday.
Scott?
Yes, Paul?
I'm sorry, I had to hop off for 1 second, but did you mention our High Rock Challenge?
I most certainly did.
And we're doing that draw next Tuesday. Our Independent Review Committee member will be doing the draw?
I did mention that as well.
Thank you.
All right, then, until next week.